it means its quoted price is less than 100. So it means it is selling at lower price. Lower price means it is selling at discount. And how we calculate that? Simple. This 100 minus 88.75. So you just say that 1 minus 11.6% multiplied by 1000, answer going to be this 88.375%. Or you just multiply this 1000 with the 88.375, you can get this 883.75. Remember, these are written in percentage form, right? Bond prices are quoted on the percentage form, right? Now, so there are two. Okay, we just have learned from our previous slide that if the price is above its face value, which is in our case 1000, it is selling at premium. Selling at premium means value is now 1015. So this extra 15 that company receives is like reserve, right? You receive in excess of the market, in excess of the face value. So remember, when you receive extra amount, it is reserve. So that's why we call this is a credit balance, right? So we are going to use that to decrease our interest payments. We'll learn in our next slides what does it mean. So, but at the end, even if you receive 1015, but at the end of the maturity, you will be giving back $1,000 back. So if I buy this pen in the black market for 300 yuan, but its original price is 100. If I want to sell after like some time when it is available, if I want to sell them to the company and I want to replace it, company going to give me 100, not 300, right? Similar concept. Because the demand was high, price gone up, I purchased it, original price was 100, I purchased it for 300, right? But company said it is worth 100. So they are going to give me 100, not 300, right? So price, market price, this 1015 eventually decreases to 1000 at maturity date, which is the maturity value. When our time period over, how much we have to give back to bondholders? Only 1000, right? So that's why we call this right now the bond is selling at premium, and eventually this premium gonna decrease the market price when it comes to maturity. Now discount, which means at the moment right now our paper, our certificate, which is worth $1,000, is now trading in the market $883.75, right? So if somebody who purchased this certificate after the expiry of the date, he will come to us and claim 1000. So that's why the difference here is called discount, and discount is our like our expense. Expense increase, debit. Right? The reserve, which is our retained earning stuff, the reserve increases, credit. Right? Similarly, that kind of stuff. But this is liability reserve. This is not owner side. This doesn't belong to owner equity. Remember that one. This is bond. Bond is called long-term liability. So that's why we don't call it retained earning stuff or owner's equity stuff. This is liability, right? Okay. So you guys understand the concept of premium and discount? So remember, at the expiration, the price of the discounted bond gonna increase to 1,000. Right? Everybody understand that? Anthony, Harry, Marilyn, Nam, Pinyo?
Yeah.
Marilyn?
Yes, sir.
Yes, sir.
Pinyo? Nam?
Yeah.
Yes, sir.
Good, good. Let's move forward. So now we have completed our discussion with what is premium and what is the discount. Now, second concept, which is a little bit tricky, but it is very easy, and that is there is a two interest rate given in bond. So one determine the interest payment and one determine interest expense. So you will now confuse that what do we mean by interest payment and what do we mean by interest expense, right? Let's just see that. So if we issue a bond is a certificate on which maturity value or face value is going to be given, date is going to be given, signature, company name, everything is given, right? Interest rate is given. So what is coupon interest rate or stated interest rate? It is the rate at which you will receive the interest. So there is also market interest rate. So you purchase this bond and this bond is giving you 9%. So can company give you 5%? Will you accept 5%? No, you will say what is written in our contract, give us that interest rate. So interest rate that is printed on the bond is called coupon. Here, coupon. Whatever the interest rate in the market, bondholders will be given coupon rate. So what happened to this 5%? This market interest rate will determine the bond price. Now, recall our discussion with supply and demand. So think in terms of that, this bond is a product, right? So this product is giving me 9%. If I invest in the market, market is giving me 5%. So as an investor, you want to earn interest. So where you want to invest? Where there is, you will receive higher interest, right? So you want to invest in 9% or in 5%? Of course, 9%. So when everybody want to purchase that security which gives us higher interest rate, its price go up. So it means whenever market interest rate is down, or bank interest rate is down, coupon interest rate is up, the value of the bond is trading on premium. Right? Let's see here. So we are going to start this after a 2 minutes break. And then we understand this concept, how market interest rate or market rates determine the bond price. Okay, guys, welcome back after the short break. Okay, we were discussing about there are two interest rates that are discussed in bonds payable, in long-term liabilities. Number one is coupon interest rate, and then number second is market interest rate. So let's do the example so that we know that whether the bond is issued on premium or on discount or at par, right? So we know the characteristics of a discount, discount, premium, and at par. So let's talk about that. So if stated means coupon interest rate, which is printed on the bond certificate, right? So and market interest rate is 6%, right? Market interest rate is 6%. So you tell me, as a buyer, because you are a buyer and I am a seller of bond certificate, because I sell certificate and I receive money, right? And I pay interest. So as an investor, as a buyer, you will buy more this bond or less this bond, because this bond is giving you 8%, and if you invest your money in the market is giving you 6%. So everyone want to buy the bond that is issued by the company. So bond prices start rising. And this is good news for the company. They will be issuing the bond at premium, right? So remember, there are two interest rates in the bonds market. That is, one is stated interest rate or coupon rate, and number two is market interest rate. We also call this YTM, yield to maturity. So what is yield to maturity? It's a finance term. Just remember that one. Whenever you heard the yield to maturity, just assume that this is market rate or bank rate, right? Now, if coupon is issued at 8% and market is also giving you 8%, so you will be indifferent whether to invest in market. It's also giving us 8%, and this company is also giving us 8%. So it means bond price will be at par, right? So company will issue the bond on 1,000, right? Normally, if question is silent, automatically assume that the price of the bond, the face value of the bond or maturity value is 1,000, right? Now, company is giving you 8% and the market is giving you 10%. So you will say that we don't want to buy your bond. I would prefer to save my money with the bank, rather buying your bond and you are giving me 8%, and in the market I will receive 10%, right?